Well, hello, this is John Yates, and I chair the technology practice at the law firm of Morris, Manning, and Martin. And I'm very pleased today to be with Zane Tarence, who is the partner and managing director at Founders Advisors in Birmingham. And Zane, it's good to see you.
John, it's great to be on, man. I appreciate the invitation.
Now, Zane is one of the leading investment bankers in the technology area in the United States, and he has also put together a wonderful book. It's called 17 Reasons Your Company is Not Investment Grade and What to Do About It. And it really is a wealth of knowledge and information for tech companies that are looking to grow. So what Zane and I have talked about doing is putting together a little interview on several of these key reasons. And Zane, maybe we can start out with the first question to tell us about Founders and your inspiration for writing the book.
Absolutely. John, as you know, we're a little boutique investment bank, and we're in Birmingham, Alabama, Dallas, Texas, and Houston. And what we do is help founders of companies, and specifically, I'm in the technology space, founders of companies and, private equity groups that own platform companies, really navigate the capital continuum. So I like to consider myself and our team river guides to help, especially entrepreneurs and founders, because I'm one of those, John. I founded two of my companies. First, I was an operator before I was a banker. And we just help owners understand their options, get prepared, for the capital continuum market, the institutional investors, and hopefully go out and consummate a deal at the right time with the right partner on the right terms. That's what we do.
You've got a great operation, Zane, and you have just done a fabulous job of building a national reputation too. So what was the motivation to create the book? I noticed a dedication to your dad. Tell us a little bit about that.
Oh man, well, thank you for that, John. My dad was a college professor and a minister, and he's still alive. He's 82 years old. And my dad, man, I don't want to get emotional here, but I've got an amazing dad, and that's a gift. The older I get, John, the more I know when you have a dad that was proud of you and you got his blessing, it was awesome. My dad was a teacher, though, at heart. My dad wanted to share ideas that mattered with people who cared. And I think that's the reason he was a professor. He was a speech professor back when you had to take speech. I think it was called rhetoric. And he was an unbelievable teacher. And my dad gave me the desire, I think, to teach. I didn't feel like I was qualified for the ministry, but I love business. And part of the reason I wrote this book is to really share some ideas that would hopefully bless people. Because I think at heart, John, I think I'm a teacher. And that's from my dad.
Well, Zane, I tell you, I've seen you in action, and both in performing services for tech companies, but also on stage in connection with the way you put on events for folks. And now I know where that charismatic style comes from, because you do a wonderful job of being able to energize people. And in that regard, maybe you can focus on, initially, we'll talk about maybe the three most common reasons you see that private tech companies are not ready for investment.
Yeah, that's good. And as you know, I have this ridiculous title, John, the 17 reasons, right? So I have seen each one of these reasons cause the company not to be able to get institutional capital, okay? But when you get me down to three, I'm going to start and see what my third one is. I know the two of them. And one of the reasons, again, I think this frames it a little bit, we found out, this is pattern recognition for me, John. Just doing deals, being an entrepreneur. I first started with IBM, and they funded my first company. And man, I'm a software engineer. I didn't really know much about this, but I'm a pattern recognition guy. Once I see patterns, I can say, okay, being naturally bright like I am, these things matter. So basically, after about 87 of these institutional deals, two being my own, that we sold, I had the help of a banker selling to two publicly traded companies. These are just patterns that I've seen. And really, it's common sense. I had somebody the other day, John, say, before I go into these three, I was going to give this speech, and I gave them a list of the 17 reasons. And they looked up in front of this group, 12 CEOs in a group. They said, well, thank you, Captain Obvious, for coming from Birmingham, Alabama. I was in Dallas before COVID, to teach us about these obvious things. Well, I had to take a deep breath and said, well, let me ask you this. Have you ever known some obvious things that you didn't do and it caused bad results? He thought a little bit. He said, it's right. I said, I know how to have a six-pack at 55. I know. I don't need any courses on don't eat carbs and exercise, drink, hydrate. I know that. I know how to be a good dad. I've read enough books. don't execute. It's execution. So some of these things sound like common sense, but they're patterns, and I see them over and over and over. And I think owners are at an information disadvantage. The buyers, the strategic buyers and the private equity groups, John, as you deal with every day, they do this all the time. They know exactly what makes a company worth money, what gives them that risk-adjusted future cash flow. But a lot of times, owners and operators, they're just not thinking at it from that line. So in that, the first one that I would say is the first one I put in the book. And I really didn't put these in order, but I think this first one is the first. And basically, it's about predictable cash flows. A business is all about risk-adjusted future cash flows, just like a piece of real estate. What makes a great commercial real estate? I mean, what makes good cash flows, a good neighborhood that you can raise rents, a great rent roll, your customers. Same thing with a business. So I talk to a lot of customers, I look at their business, and they don't have recurring or reoccurring or predictable cash flows. Now, I want to say one thing on this, John, we can talk about a little bit. It doesn't mean you have to have 5-year contracts. It doesn't mean you have to be a subscription-based company like a Netflix or a SaaS product that's enterprise software, but you have to have the data to show that your revenues are not just sporadic. They're not episodic.
Right.
Your customers do business with you year over year and do more business because you're delivering something special. So it's the cash flow attributes of your business. And people that have lumpy cash flows, there's not really institutional buyers. So really, really focus on how you can prove that you have stable, consistent cash flows. And John, this is the reason some companies trade. I mean, we recently did a deal at 11 times revenue. In the past, that would be unheard of. But also, there's companies in the same sector that might sell for 5 times, 6 times EBITDA. And there's some companies that won't sell for anything because they have lumpy revenue streams. Does that make sense?
It's a great explanation and great highlight of fact that companies, I think, sometimes delude themselves into thinking that they've got a really nice business, but there's no predictability to it, which is really important for valuation purposes.
Man, it is. Hey, John, can I add one other thing to this? Because I'm a story guy.
Ooh.
This also one of the reasons that made me finish this book. Writing this book is probably one of the hardest things I've ever done because you just have to focus. It took me 4 years, even though it's very simple, but just to focus on it. One of the things that made me finish this book was I was invited to a family office meeting with the patriarch of the business, the matriarch, their 3 kids, and 2 of those kids' spouses. And in that family office meeting, the group that helps them manage their wealth, they had their attorneys that they trusted forever, that helped them in the business for 40 years. They had their CPAs, they had their wealth manager, and the dad even had his coach. And we were in that meeting. And they had invited us to come to a piece of that meeting and talk about their wealth that was wrapped up in their private company. That's the way they made their money. They had saved a lot of money, invested a lot of money. A nice little business. And the business was doing about $8 million in EBITDA, so in cash flow, in earnings. They didn't have any debt. And we were invited, John, this goes to your first question. Why did I write this book and why is recurring revenue so important? We were invited to talk about the wealth that they had tied up in this private company. John, it was a tech-enabled services business. So it sounds like, man, it's going to be a great business. We got all the data. I started knowing, oh no. And I front-run this with the CPA and the attorneys. They said, no, come on and talk about it. I had to stand in front of a family that was thinking this business, 10, 11 times EBITDA. And the end of the story was, this company is not marketable. You need to keep it and just get the cash flows and invest it in apartment complexes because it's not institutional grade. And the reason is this reason. There was a couple more, but very, very lumpy revenues. It's like, oh, I hope and pray my customers come back next year. To where some businesses, you start January 1st, you already know you got a certain amount of the business book. So sorry to harp on that, but that broke my heart. And I said, I don't want to do this again. I would like people to know this 20 years in advance, or even when you start your business.
It's a great point because what happens too, I think if companies don't hear that kind of hard lesson, Zane, what happens is they They start the process, they go through it, they think it's going to be great. They spend a lot of time, they get frustrated, they get 4, 5, 6, 7, 8 months into it. They say, why didn't I get the valuation I thought I was going to get?
Right.
And they stop the process. And so they've just lost, the better part of a year in the process. Great point. All right, so walk me through the second issue, the second big reason here. What do you see is behind this notion of recurring revenue or lack thereof? What's the second big problem?
Yeah, and I hit this, and this is my reason number 7. And this is companies that don't have a defensible moat. They don't have something that's a barrier to entry to make them different. So basically, as an investor or as a strategic buyer, I can just go and compete with you. I can just go hire your best salesperson. And why am I going to pay $50 million for your business when I can just hire your best salesperson? So really, it's about that barrier, that moat. And John, you've heard me tell this story, but this is the first part of that chapter in my book. Is a buddy of mine, who's a hedge fund manager, was out at Berkshire Hathaway's annual meeting. And I tell this all the time because I was like, that's got to be a reason. And I knew it was a reason, but Warren Buffett put it a good way. Somebody was asking questions to Charlie Munger and Warren at break. Guy walked up to the mic, 800 investors in the room in Omaha, and said, Charlie and Warren, all you've been talking about today is how all your companies have this thing called a defensible moat, a moat around the castle, barrier to entry. My father and I own an HVAC supply company. Could you please tell me and my dad on the mic how to build and create a defensible moat? My buddy said, Warren Buffett, he called me right after this happened, moved the mic over and said, how do you create a defensible moat? Let me tell you, I don't know. That's the reason I purchase companies that have them. Defensible moats are very, very valuable. So have an honest discussion with your stakeholders, your partners, your employees, your customers, your suppliers. What makes us different? What makes Morris, Manning, and Martin different? There's a lot of good law firms. What makes y'all different? What makes Founders different? And if you can't say that, if you don't know why you're different, and if your competitors can just come in and copy it, why are you you're never gonna get any value for your company, John. Now, does that mean, you need to quit? It's a terrible business? No, I see unbelievable businesses making a lot of money, but they're never gonna sell. You need to understand, I don't have any enterprise value. I just have cash flow value. So that's the second most important one, I think.
Quick follow-up, Jane. So it doesn't mean necessarily just intellectual property protection, which obviously is nice as a moat.
That's nice.
Just have IP protection. A lot of companies don't have IP protection, but it could be a mix or it could be one or the other.
Yes. And John, these are things like, you have a patent, sure. You have all these wonderful IP things that attorneys help you get, awesome. But a brand, I can show how a brand is absolutely, somebody can't build that overnight, right? They've got to buy it. Same thing with a culture. I sold a company recently. I can't announce this, but let's say we sold it to a Fortune 5 company. A Fortune 5. They haven't had to announce this yet somehow. John, they bought this company as an acqui-hire for their 17 software engineers that didn't want to move out west and work for this company. But they said, we'll let you live on the East Coast. You all went to college together at Cornell. You can stay there. They bought them because they cannot go recruit this team in the certain mixture and culture and what they're creating. That's unbelievable, but they want the team. So you can build it in a culture. You can build it in a product market fit, systems and processes. Sometimes, John, it's just the order you do something. It's the way you organize your work and you create this outsized gross margin. That shows you have a barrier to entry because you're doing more or less and doing it better, right? And so you can charge the same price and still make a higher margin, or you can produce your product at the same price, but sell it for a lot more because it's so much better. So one of the things I always tell people, they say, hey, Zane, and sorry I talk so much, John, you know me, you got to interrupt me. I get passionate about this because this matters. It matters. I talk to people, they say, Zane, I've got a defensible moat. I've got a competitive. I say, hot dog it. John, tell me about that. They go, man, I got the best people ever, the best customers. I said, prove it. And they go, well, I don't know how to prove it. I said, I don't know how to prove it. Let me see your financials. And if your gross margins for other law firms, for other banks, for other manufacturers, other SaaS companies is higher, you just proved it. And a buyer will pay up for that. Big time.
It's great stuff. It's great stuff. So let's talk about a third. You mentioned that might be a challenge because you had 17 of them. You knocked 2 of them out of the ballpark here. I'm wondering what's the third.
Okay, I'm going to give you the third. It's not sexy, but it's real. And John, I got 2, so I'm going to do it real quick. You can cut me off. I got to tell one, and it's not because you're on the phone, bro. It's not. I mean, I appreciate you, and I appreciate you reading that introduction that my mom sent you because that sounded really, really good. So, but I'm going to tell you, I want to give something to number 13 and 14. With your financials, get your financial house in order and your legal house in order. If I had to say the most common reasons deals fail, and the buyer was excited, now if you ask me the common reasons, that they are not ready, the reason they fail is because their legal house and financial house is not in order. The buyer's like, oh, I think they have everything. Then they start digging a little deeper, and guess what? The foundation for that house is faulty, and deal's over. And so I had to bring this one up. And one of the ways I started, one of my recommendations in the legal chapter, John, was get your attorney to do a legal readiness. Do not go to market with a crack in your foundation. That has to do with consistent supplier contracts, any kind of lawsuits, any kind of drama, any kind of intellectual property you don't have wrapped up. I got a deal right now. Oh my goodness. And you know about it, where the owner's having some issues with work for hires. Some of their people never signed off that they didn't own this product, and that causes a problem. So legal and financial house in order, that's the number one reason that deals ultimately fail. Okay, so you've got to get ready. So I had to throw that one in. But let me give you a third one. I'd say customer concentration, where you're not ready. What do buyers and investors want? They want growth. They want that future cash flow. What they don't want is risk. They hate risk. They hate it. That's the reason they want good financial housekeeping, good legal, good recurring revenues, a good barrier to entry. Customer concentration. We see a lot of young, and John, I work with tech companies all the time, a lot of young tech companies that land a huge customer. And that logo is awesome. I love it. I'm for it. But once you have that big customer, it helps you, right? Customer funded development to move to the next one. Get additional customers. Because if you have all your revenues tied up with a few key customers, what if that customer left you? Your value's not there. And they're not gonna buy it. So you've got to have customer concentration where you have a lot of new customers. And I tell people, have a new account culture. Don't rest on your laurels. Just like because you have some great customers, like, oh, let's just do more business with those customers. That's good because you want to land and expand. You want to show that you can grow. But if you can't get new customers and show an institutional buyer that you have a culture of getting new accounts that come on and you onboard them successfully and they buy more from you, you're not ready because it's too much risk. And John, people say, well, what's customer concentration? What's good? What's bad? Depends on the industry. I just did a deal with a defense contractor. Well, shoot, they only have 6, potential customers, counting the Coast Guard. So if they're spread across that could be good. But then in some businesses, if you have 6 customers, you're not worth a dime, So it depends on your industry. But I really, 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 whatever industry, I don't like to see more than 40% of your revenue amongst 12 customers. That would scare me.
See, that's a good benchmark there, Zane. So let me ask, we're going to come back and we're going to cover the remaining 14 or so reasons in a subsequent discussion. But one of the phrases that always comes up and that we harp on with our clients is that time is the enemy of the deal. Yes. And the idea that, so some other things you talk about are setting things up properly. Can you just share with us just briefly why that phrase makes sense and what it really means for companies when you're trying to get a deal done and how important it is to get it done on a timely basis and in a smooth process or as smooth as possible?
John, you're speaking my language. Time kills deals. That's the reason preparation is so important. So when you get out there and you have people looking at you, buyers looking at you, that you're prepared, there's no surprises, there's no drama, and things can go smoothly. People say, well, these institutional buyers, they're all just calculating technical people, right? They are. They're very, very smart. But let me tell you what else. It's emotional. And if drama starts popping up, and I thought something was that way, but then I get it deeper in and you're not prepared, your numbers weren't right, I start getting scared. If this popped up in their legal house, what else do I not know? And I see very smart Harvard, Yale, Princeton, finance people get nervous because the deal takes too long. So that's the reason, John. It's all about preparation. Be ready. Don't go out on the stage until you're ready. And that's the reason I am passionate about the right advisors. Please have the right attorneys. Please, that have worked with you for a long time. Please have the right financial advisors. Please have the right M&A advisor, investment banker. And even if it's not us, please have one, because they can prepare you and keep you on a track of speed. And also, you don't want to put your company through a process that goes too long. It's brutal. So great point. Time Kills Deals, be prepared. And that's another reason I wrote this, just as a checklist to say, I just want to know what to expect, so I'm not embarrassed and I don't enter something that I can't finish.
So Zane, we have about a dozen more of these to go. So we're going to have another session for the benefit of those listening. Again, the book is 17 Reasons Your Company is Not Investment Grade and What to Do About It. And Zane, tell us real quickly before we sign off on this first interview, where does somebody get this book?
Oh, man, thank you for asking, John. It's on Amazon, but you can go to my site, Founders IB, but you can go to 17-reasons.com, and it has Amazon, Apple, and all that. But thank you, John, for letting me say that.
My pleasure. Zane Tarence, practical advice from an owner investment banker and the head there of the Founders Advisors. Zane, we appreciate it. We value the relationship with you, and great information for the audience. Thanks.
Thank you, my friend.